It doesn't take much to get me started on a memo. In this case, one sentence was enough. In an article from the February 4th online edition of Pensions and Investments, as described by Fierce Finance on February 28, the long-term equity risk premium is typically between 4.5% and 5%. There's little I hate more than investment generalizations. For years, for example, self-styled authorities on the high-yield bond market would say bond defaults typically take place 2 to 3 years after issuance. That always set my teeth on edge. The time to default might average 2 to 3 years, but unless one, that's also the most common time period, the mode, and 2, not a highly variable parameter, which I think it is. That generalization is absolutely useless. Read this week's cover story on Howard Marks. In fact, I like the way Mark Twain summed up on the subject more than 100 years ago: all generalizations are false, including this one. I consider most investment generalizations as useless as that great oxymoron, common sense. Back to equity risk premiums. The Fierce Finance article in question led with the sentence, "The great rotation back into equities from bonds is unlikely to be seen in 2013 among most defined benefit pension funds in major markets, including the US, UK and Netherlands." It included a number of what I consider provocative statements. That pension funds do want fewer bonds but generally not more stocks, raising the question of where the money will go, and specifically how much money can responsibly be absorbed in asset classes other than stocks and bonds. That, according to one consultant, there is recognition that bonds represent minimal risk assets, so it's difficult for plan executives to abandon bonds in favor of equities. This overlooks the fact that there's no such thing as a minimal risk asset regardless of price, and few assets that have been the beneficiaries of years of strong cash inflows can really be minimal risk, and that investors are taking short-term tactical advantage of the rising equity premium by, for example, allowing multi-asset managers to drift toward the higher end of the equity allocation range. So there we are, in the third bullet point, back to the matter of the equity risk premium.